welcome to our asset management panel. I wanted to say thank you to whoever put the online marketing material on the system. You called me the managing partner of my firm, so I got a promotion, and I didn't know it. They forgot the comma New York office, but that doesn't matter. So we're very excited to talk to you about asset management. And a lot of people don't even know what asset management is. Okay, the common definition, managing the asset. But we thought we'd take this opportunity with our introductions for each of our panelists to tell you how they got into asset management and or what asset management means to them. So we'll start with you, Lisa.
Okay. Can everybody hear me okay? Okay. I'm Lisa Bevacqua. I'm the head of asset management at Silverstein Properties. I've been there for almost 13 years. I oversee about 16 million square feet of office and multifamily properties in New York City, LA, and Philadelphia. How I got into asset management. So I originally was doing leasing, commercial leasing, and then I was doing acquisitions and asset management. And during that process where I saw assets kind of cradle to grave in terms of buying, managing, executing the business plan, and selling them, I realized what I enjoyed the most was the coming up with the business plan and then executing on it, working with our investors, adding that value. And ensuring that I got to work with many different people across the organization as well as externally. So that's what I love about it. That's why I got into it.
Hi, everybody. Is this on? Yeah, great. I'm Peggy DaSilva, and I'm the head of asset management at PIMCO Prime Real Estate. We were formerly known as Allianz Real Estate. If anyone is confused, it's one and the same at this point. But I wasn't going to say how I got into asset management because it wasn't really the greatest story, but I've been encouraged by my fellow panelists to tell you, and I'm very happy that I'm in asset management. I've been in the real estate industry for over 30 years now, and I've certainly seen a lot of cycles. Really spent my whole career here in New York, but very focused on real estate across the US and in Canada. At the time, I was working for a large bank, I won't name names, but I was doing acquisitions. And they decided in one of the cycles that they were going to downsize. This was in the early 2000s. So they literally fired all the women in the group but two and put the two of us in asset management. So that's actually how I came to asset management. It really wasn't a choice. But over the years, I think like all my fellow panelists here, I really do enjoy it. I think you learn a tremendous amount. You get a lot of exposure. As Lisa said, you really work with all kinds of people, whether they're external partners, brokers, leasing agents, consultants, advisors, internally. You know, it runs the whole gamut. And I think there's so much satisfaction when you're working on a project and you're creating the value and you actually get to see it come to fruition. It just takes many, many disciplines in asset management. I would say, despite all the years, there's really never been a dull moment.
Hi, I'm Lesley Lisser. I currently run the Northeast multifamily platform for Invesco. It's about 8,000 units from DC to Boston, including 4,000 affordable units in New York City, which I'm sorry I missed the affordable panel. I would like to have heard from my partners and lawyers and whatnot. And we are partners with L&M, Fairstead, and Avalon. I've been doing asset management since I graduated NYU in 1994, in one form or another, all asset types throughout. When I was at NYU, there was one class in asset management taught by a guy I ended up working for at Emmis named Larry Davis, but that's another story. Very few people really didn't understand what it was. And what it means to me, and I thought I'd just get into that a little bit, is really involved with all aspects of managing the investment, executing the business plan, coming up with new strategies to make sure you maximize value. Day one, even though you've helped with the underwriting and did everything, day one, the asset plan is wrong. It's off. And it's your job to check it against pro forma, come up with a new way to earn the money, or at least understand why you're not earning the money, and be able to, figure out the best strategy for the asset. I love interacting with people in this role as well, and I think that's important to understand that I'm dealing with construction issues, engineering issues, waterfall issues, JV partner issues. I get to interact with managers, maintenance teams, lawyers, up the chain to clients and JV partners. So there's never a dull moment. Every day is different, and that's why I enjoy it.
Okay, I guess I'll finish us off. I'm Carly Miller. I'm the U.S. Head of Asset Management at PGIM Real Estate. I actually started off my career as an investment sales broker in New York, and a few years in, we were actually selling a building where it was like my job to come up with a reason for why it was worth, someone should pay more for this building. And I came up with a really harebrained scheme where we could build a multifamily condo on top of the building, which was a fully occupied office building on top of a retail department store that was also leased and occupied, and you would have to reinforce every single column within the department store, which we didn't have the right to do, and some investor should come and pay us more for that. And so I came up with this idea, and we ultimately sold the building for a lot of money. It was a really good time in the market. But I thought to myself, is someone going to use my business plan? Am I any good at this? Do I have, actual good ideas, or am I just like selling the dream? And so I decided at that point that I probably wanted to get into asset management. It wasn't exactly a straight line at that point to go from investment sales brokerage to asset management. So I did acquisitions for a couple of years, and I joined PGIM Real Estate 16 years ago. And during that time, I've worked on pretty much every product type except for senior housing directly, and now I oversee our US portfolio, which is about $65 billion across all product types. So office, industrial, multi, retail. We've got senior housing, data centers, storage, manufactured housing, you name it. We've got a little bit of everything. To me, everything that Lesley said is exactly right about asset management. I like that you come in during the day and you don't know what your day is going to be like. You come in and you think you have your list, and then a whole bunch of stuff happens and you deal with it differently. But to me, asset management is really about perspective. Those who have perspective and can see what needs to be done in a difficult situation and understand how to outline all of the risks and decide which is the right path, those are the people who are the most successful.
Well, I think you touched on it. So the key thing is you want to maintain, but more importantly, improve the value of the asset once you acquire it. You want to keep for those of you that saw the financing panel, you want to keep your lenders happy. And so right now, unfortunately, interest rates, pandemic, flex work programs, office is probably struggling the most with keeping their value, and unfortunately maybe some office is losing value. But one of the key things you can do to maintain value is to keep tenants. So what kinds of things do you think are being done right now to keep your tenants and your buildings occupied? And we're going to start talking about office first.
So I could start with that. So we're doing some of the same things to keep our tenants as we are to attract and new ones to our properties. So a couple of years ago, we created a whole amenity platform with hospitality-like service within our office buildings. It's called Inspire. So we've got all the amenity spaces. It's funny when you look at our early amenity spaces versus the ones we've built more recently. They get nicer and nicer and nicer as it's gotten more competitive. But the amenities are a big piece of it. Unfortunately, I think unless you have amenities, we're not even tenants won't even tour the building. So we're fortunate in that we got out ahead of that. It's the service levels that we're focusing on. The other thing is flexibility. Any tenants that are coming to us now, whether they're already in our buildings or they're new tenants, they're looking for termination options, they're looking for different structures of concessions, things like that. And so we've had to get pretty creative in terms of how we can still make the numbers work, but offer these different types of options to be flexible. It's definitely something that we need to do in this market. Sustainability is something that we're also focused on for both sets, existing and new tenants. That's become more and more important these days. It's on the list that tenants have when they come to our buildings. They want the profile as it relates to each of our properties. And then the last thing I'll say, which has been helpful for us, and I'm sure for the other panelists as well, we're getting more and more requests for the financials of the ownership. When a tenant comes to our property, particularly the large ones, it's almost like they're doing a credit analysis on us. They don't want to lease space in a building that doesn't have super strong ownership, that's well capitalized. Maybe there's a debt, the debt's maturing in the near term. they are very focused on that profile. And fortunately, that's a competitive advantage for us because we're very low leveraged, great ownership, reputation, well capitalized. So that's actually really helping us now, which has been very interesting.
Yeah, I would say really all the same things that you did. We are particularly focused on the sustainability aspect, and I would say as ultimately a German-owned company, I think we've probably been out ahead of this really more than any other, American owner. We have very high standards. We must subscribe to European standards, not US standards. We don't care about GRESB, we don't care about LEED. They're all sort of a joke to us compared to the levels that we have to abide by, and we have found that it does speak to tenants. We also, in addition to what you're saying about the amenities, which we're focused on, find that our buildings can be very desirable to tenants because we don't have any debt, so it's the same thing, in terms of the financials. They want to know who the partners are they here to stay, are they able to provide the CapEx they say they're going to provide, which is what the draw is for the tenant. One of the other things that we try to do, of course, is since we have a national portfolio of office, if we have a tenant in one building in one city and we know they're looking somewhere else, we work very closely to try to coordinate all the efforts, and we try to really tap in across our internal network. Who knows these tenants, who has interaction. We're working on one deal now where someone on our group is very involved in the real estate roundtable with the CEO of the company who's looking at the space. And so it's really figuring out all those ways to connect the dots and make yourself stand out, because it is a very difficult market. And finally, I'll just say, we're really focused on retaining tenants. It's harder, I think, to get the new tenants to come in. Everyone who's an owner is trying to retain them. So it is the dollar and cents game and everything that you can provide. And if they didn't like what they saw in the building, you really have to convince them that you're going to do different things, because otherwise they don't believe you.
So when you say that you're trying to retain tenants, if they have a renewal coming up, are you trying to get ahead of the game before they exercise their renewal, because no one wants to go through a fair market rent process, right? So you try to get ahead of the game?
Absolutely, like years ahead of the game. And same on the debt. If you have debt, if your debt is coming due in 25 or any time in 25, already in discussions with the lenders, really trying to stay ahead of whatever's coming your way, because every other landlord out there knows exactly what the rollover schedule looks like, and they're all over these same tenants. I mean, we've had tenants tell us they're leaving 3 years before they're going.
Tenants are looking earlier and earlier at this point, and so that's kind of interesting. If they wait until a year and a half before their lease is up, they're actually not gonna be able to execute all that well. But if they start looking early, it gives you a lot more leverage both with your existing landlord and with a new landlord. And when tenants are looking at spaces, they're also now coming with a new request, which is a little odd for us, but they're saying, do you have investment committee approval to do this deal? Because they don't want to negotiate with you in advance to find out, someone decided that they don't want to spend the $10 million to do your build out and pay for your leasing commissions. And so they want to know upfront not only what your capital structure look like, but that you're actually approved. And that's kind of changing how we have to manage our business, because generally we kind of work within the confines of a budget and what we think our plan is and go for the final approval once the deal is cut. Right. So now the question is, do you go for approval for the deal you think you're going to cut, or something that's close? And then, how does that exercise the internal organization as well?
One of the other things we're seeing too is that tenants in negotiating both the TI and the free rent package are saying, let's figure out what the total cost of that is that you're offering us. That's just like a lump sum. That's how much we're essentially taking off the rent for X number of years. We'll figure out how we want to spend the TI and how we want to allocate it between free rent and TI. So if the whole package on a 10-year lease works out to 4 years of free rent, that's basically what we as a landlord are getting, 4 years of free rent. We're not parsing out that money over a period of time. It's all up front, one lump sum.
It's that flexibility piece that I think has been really accelerated in the past year or so. And if we don't get flexible with how we're willing to structure the deals, then they're just going to go down the street. I think the other thing on the renewal side that I'll mention is what's making it really challenging is all of the existing tenants know they're in a good spot. They know it's really hard for all of us to attract new tenants. And so the concession packages, at least that we're being asked for, are the same on a renewal as a new deal was pre-COVID. And so the economics are very different. And so, when we pull out all of our projections, and a lot of asset management is, the sort of financial modeling and looking ahead, as Peggy was saying, and getting out ahead of things. What you underwrote or whatever was in your business plan from a couple years ago that's in your Argus as it relates to your TIs and your free rent is out the window now as it relates to all of these existing tenants. And it's tough to make the economics work. But at the end of the day, you got to figure it out, because otherwise they're going to go somewhere else.
I remember the days where you could give a renewing tenant paint and carpet.
Right? Right.
That is
Yeah.
no longer the day.
No.
Now, not only do you have to give them the exact amount that you have to give to a new tenant,
Yep.
but because they might be changing their footprint or reducing their space by some percentage, they also need flex space. So they can move into the flex space while they rebuild their existing space to make it work for their new needs. So it's been very interesting, and sometimes the economics there, you used to get payback maybe in a couple of years, and you could be in certain markets 5 to 7 years. Chicago is probably the
They want to
hardest.
set determination after 7.
Yes.
By the time you're actually making money, they want to terminate the lease. Yeah.
I've been hearing numbers over $200 a square foot for renewals in TI, which is a building.
Yeah.
Right, and they all want as much flexibility as possible. In the old days, you'd say, okay, you get a tenant improvement allowance. If you don't use it in X number of days, sorry, you've lost it. And now it's like, well, if you don't use it, then I can convert it to free rent. I want you to pay my moving expenses. So I hear you saying it's equally as hard to keep your existing tenants as to attract the new tenants. So you're basically, you've kind of lost the advantage of keeping an existing tenant around because it's just as expensive to keep them.
But it's hard to find that new tenant
Right.
who wants to. I think one thing we haven't really talked about that is very prevalent in the market, particularly in New York, is the distinction between trophy buildings. Like what we're saying here, I think, is not applicable to every single building, every single office building in New York. When we think about buildings now and classifying an office, there's trophy, there's like Class A plus, there's Class A that's Class A, but it's not so great, there's Class A minus, and then there's B and C. But they're truly trophy buildings, and I don't know, I don't want to say this, but maybe you can count them on 2 hands. I'm not really quite sure, I haven't done it. But those buildings are getting extremely high rents. The economics make a lot more sense. They are commanding high TIs, but there's a fight for that space. So you do have much more competition among the tenants who want to be there. And you can think Hudson Yards is the most obvious example here in New York. So everything is, every building's not the same. What we're talking about here I think sounds a little bit general, but you are really seeing a differentiation depending on the quality of the building.
And the have and have-nots.
I was about to say the spread
Yeah.
between the have and have-nots has
Yes.
widened considerably, and the haves are still doing well. They have rent growth. There's the economics make sense. There's very little vacancy. The have-nots are really struggling, and that's there's not a lot you can do to save those at this point.
And would you say that's true, because I know you all have assets across the country. So is that true East Coast, West Coast, Mid-America, where there's really, we'll call it the survival of the fittest?
Yes,
Yes.
absolutely.
And so what happens to the A minus, B, C classes of buildings?
There are always going to be markets, particularly suburban markets, who don't have these kind of trophy buildings the way that you have in New York, that don't have the Hudson Yards or some of the other new construction with all the amenities, and they're not 2 million square feet. But those buildings have other things that they bring to the table, kind of location, maybe if it's in a mixed-use environment where there's other amenities on site, things like that. Those are the types of things that I think tenants are looking for. Live, work, play is a really big thing as well, and I think that draws a lot of people.
And more affordable. I mean, every tenant is not, a very high-paying tenant that can afford that. So there are still so many businesses. But I think that, there could be more of the B-quality space than there are tenants necessarily to fill them if you think about remote work, downsizing. But there's definitely still a need for that.
We just bought a building downtown that we're going to be converting to residential. And so, there's a lot of talk of the need for housing in the city and all of these Class B buildings, Class B and C buildings, and, converting those. And I think this is the first time we're doing this conversion at Silverstein, and it's been a really interesting process. I think when I read all the headlines, it makes it sound like there's tons of opportunities out there for these conversions. But it's really it's like finding a needle in a haystack is what we found. The basis is critical. The existing buildings, the floor plates, the mechanical systems, the light and air, it's the zoning, the age of the building. I mean, the list goes on. And so when you actually take all the potential candidates and you start to narrow down the potential options, there's really not that many. But I'm sure some of them will be converted.
Opportunity is
Yeah.
what you have to say in the downturn of the market. And in asset management, you have to look at what's the opportunity, how can we best position this asset?
If the numbers pencil out. I mean, right now, there's no tax incentives, there's zoning issues, there's a lot of things, like an air
capital.
views, there's, besides the capital, penciling out.
All right. Well, so moving on to multifamily, since I think we talked about office enough. I know office is everybody's topic, but multifamily is still chugging along, and especially in the city, I understand there is, not a lot of availability, so that's creating pressure in the market to provide things for the tenants. So what have you been seeing in the multifamily market in terms of attracting tenants and what needs to be provided to those tenants?
So I'll take a stab at answering that. Look, New York is by location, it's by neighborhood, it's by desire to be there. We're not having problems filling our buildings in New York City. Where I'm seeing a little bit of worry, where I'm worried about is really economic factors coming into play right now, especially with seasonality approaching us, and definitely a pushback on rent. I don't know if we reached the top, but I feel very much right now with seasonality coming on that we have. And if you think about it, I'm charging between $6,000 and $7,000 for a one-bedroom apartment. How many people can realistically afford that? We'll see. But talking about amenities, my New York portfolio compared to other Boston and DC has less amenities. But I'm finding that it's critical to have the outdoor space, a gym with good equipment. You don't need a big gym, you just need really good equipment. And also, we're focused on creating a sense of community. It used to be, New York, they don't care. Well, they do care. I see evidence of it, they socialize. So we're looking at ways of, hopefully, making more affordable event options, having apps that provide services, and actually people are using them. They're scheduling their dog walkers, their cleaning services, all through these apps, and it's something that I didn't think New York would take hold of, but it sure is.
Yeah, we on the rent side of things, we've been able to get rents that are like 20-30% higher in our New York multifamily than pre-COVID levels, and it's like within the past maybe 6 to 8 weeks or so, we've started to get the pushback on the rents. We're starting to see concessions popping in. I think people are starting to get nervous. We're going into the slower season, like let's try to get some occupancy. But for the most part, even if the pricing kind of stabilizes, we're still way up in terms of that rent growth.
But we have also, debt issues, expense creep, insurance creep.
Right.
Everything is so much more, so it does impact.
And I was just going to say, the increase has been significant, but unfortunately, from an NOI perspective, you don't really see all that much difference just because of everything else that's going on right now, and certainly from a cash flow perspective, because at least for us, the loans that we do have, many of them are floating rate loans that we put in place back in like 2018, 19, 20, when the rates were super low. And fortunately, we have caps on that, but those loans are coming due. And so looking at the cash flow and trying to figure out the next couple of years, the cash flow is going to get eaten up by the higher debt service we're going to see. So it's definitely a challenge.
And we forgot to mention the 421A and affordable property that we do have. Mm-hmm. You're limited on your renewal increases, as you know, and people are staying. Retention rates could be 70-80% some months. So you're not getting back the product to market as quickly as you want to right now, and that's also impacting cash flow.
We actually have a large multifamily portfolio. None of it is in New York. And we've definitely seen issues, across the country. The Pacific Northwest has been hard hit.
Terrible.
No rent growth, really, we've seen crime. We've also seen, difficulty, higher vacancy rates. So New York, I think, might be its own place. And we're also starting to see that there's a huge amount of supply in the, in the Sun Belt area. Everybody was flocking there from, the Carolinas, Florida, Atlanta, all the way across to Houston, Phoenix. There's a lot of supply, and I think that there are issues to come there. We're already starting to see some of the cracks. So there'll be all kinds of pushback, I think, and then the debt issues on top of it.
So I think we're still seeing, and we have obviously a national portfolio, and so each market does behave very differently. I still think in New York, we're still seeing some rent growth, but the pace of growth has slowed considerably. We've also had crazy outsized growth for the last few years, so maybe we all got a little bit spoiled. Another thing that we have our eye on is that there are municipalities who are considering limiting or instituting rent control where it's otherwise not there, and so you might be anticipating that you can grow your rents by a lot. Now, these numbers are limiting it by kind of a realistic type growth, and so maybe we're not going to assume that we're growing at 10% per year, and so maybe the underwriting still works, but there's a couple of cities where we really have our eye on that when we're underwriting buildings. And then, you're right, the cost of everything has gone up. Inflation has been high. I think that the cost of labor has been high, insurance has gone up, and so that all does hit the bottom line, particularly in multifamily, whereas in commercial, you pass it through to your tenants, so it's a little different.
Yeah, I have regulatory concerns in every market I have, from DC to Boston,
Yep.
including New Jersey. So they can have rent growth, they can have vacancy decontrol, but capping on the renewals is what we're seeing.
It's a big issue out west, California. If anyone follows all the local bills in San Francisco, Los Angeles, every time one comes on the ballot, which is almost every year, then there's a scare. If anyone followed the millionaires or whatever, the mansion tax in Los Angeles.
It's very famous
Yeah,
in
put
Los
a real
Angeles.
pall on that market. So again, you have to really look at all the factors at play.
Right, I think the cost, the rents probably in New York have grown exponentially, but I don't think they have grown as much in the other markets. But the costs of operating have continued to skyrocket, the insurance, the labor costs. And so I think other markets are probably struggling a little bit more than maybe what New York is. Is that a fair statement?
I think so. I think also it's not just the cost of labor, it's also the services one provides at the building. The standard has risen over the years. The amount of amenities that we're providing and the level of service, it requires more staff. I was at a building the other day where we have like grills on an outside patio, and there are people who actually have to man the grills. They don't allow for people to cook themselves, so that's an extra level of service we have to
That's
provide.
also an extra level of insurance, service.
Yes, it is.
And insurance.
Well, it's also older product too, and we're finding that, maintenance is becoming a real issue, and we're looking at, upgrades to units that we didn't think we'd have to, but older product, compared to some of my other portfolios, so we've got to put more capital into it.
Well, that's interesting. As you're seeking out tenants, are you finding that in multifamily, they want just as many amenities as what office users want, and what kind of amenities are they looking for in a multifamily building? Carly, you're laughing, so we'll let you answer this one.
I was talking to our head of multifamily about this yesterday, and oftentimes in our buildings, we don't even, tenants say they wouldn't have considered our building if we didn't have X, Y, or Z amenity. If we look at the utilization of those amenities, they actually rarely use them. They want to be able to show their family when they come to town and have the option to use them, but they're really not using the golf simulator and the outdoor screen that has movies on it, and the massage chairs and
The salt bath, the salt room.
the salt room. We have a bowling alley. That's a good one.
Yeah, so that's tough because they all want the amenities, but they're not being used. Backtracking, do you think that's true in the office setting too, where people want the amenities, but they're not being
Yes.
used?
Absolutely. I call it window dressing. I mean, you have to show it, and the tenants are really asking for it, but they barely use it.
The practical stuff, though, like, so we found it on the office side, the more practical the amenity, the more it gets used. So, for example, we have large boardroom kind of conference rooms in most of our amenity spaces. So the tenant doesn't have to include, you know, in the envelope of space that they're leasing, they don't have to build out a room that they're going to use 4 times a year. And so it's a very practical, so that's constantly booked, conference rooms. Also, you know, there's a real desire for a choice of where to do your work based on what work you have to do. Do you have to read a legal document, or do you need to brainstorm with, you know, your team? And having multiple space options depending upon what work you need to do, we've found has been something that's actually helped get people back to work. But those amenity spaces that contain those types of things are actually utilized much more than just, you know, the yoga room or the meditation area that we've got.
Yeah, multifamily, we're finding that if we have workspaces, they have to have a sense of privacy, because those long tables no longer work. You've got one person sitting there and the rest of the table's empty. So we are reconfiguring things and making sure people can have some sense of privacy.
And I think the flexibility of amenities is also important. So if you have an amenity that can be used as a flexible space in one day, and then you can use it as something else, that's really helpful. But particularly going back to office, having the ability for a tenant to come in and potentially take a little bit less space because you have this available to them, that's a big selling point.
Yeah, and having food, we're also finding with the amenity, food is really important. Like, not the food in your lobby area, but to have a lounge that has, by day, maybe coffee, and then after 5 o'clock it's going to have alcohol, and that's available to the whole building. Again, so the tenants are mixing. I think you were talking about community on the multifamily side, but we've also seen on the office side that there is a desire for tenants to just know who else is in the building. It's just a social thing, and they like having this lounge because they can come down with their work, you know, their colleagues from work, and then meet another group of colleagues from another company that's on a different floor, and they all have a drink together or whatever it is. So we do see that as an amenity that people ask for and actually use.
It's the concept of a vertical community is definitely it's a really important thing these days in an office building, which is not something that would have ever been contemplated. You know, in the past, you didn't want the tenants talking to each other, and now it's being, you know, it's certainly encouraged. And the amenity spaces where we have liquor, those ones are the most popular for sure.
And then also just bringing hospitality really into every single product type is actually very important. We see in office and in multifamily buildings, and in retail as well, we program, you know, a lot of programming in there. We offer classes and events, and that kind of brings people together in the community, and it really raises the profile and helps that.
But you just have to be careful of those costs, and that's why we look to virtual. Now we do it by app. We enrolled rolling out an app service called Flamingo. I'll give them a plug because I really like it so far, and we're doing all our events through them and all the services through them, and I'm cutting my costs by, you know, thousands of dollars. So we've got to do those things. We're doing also self-guided tours, all these things to kind of lower payroll. We're eliminating staff. We're also doing energy saving programs to reduce utility costs. All of this stuff is being done to offset everything else we're seeing in terms of expenses. Super important, though.
So do you think, and I'm sorry, I'm backtracking to office because it was interesting hearing all of you talk, because a lot of office users are downsizing because people are working with more flexible schedules. So maybe that's an opportunity for office buildings to put in these more flexible common space to book for conference rooms and book for huddle sessions and different kinds of things.
It is an opportunity, but think about it, you're not renting that space anymore for, you know, it's not rentable,
Yeah.
you're not getting any cash off of it.
Right, it becomes a
So, you know, that
pass-through
amenity that's
expense
the
that-
full floor is lovely for all the tenants, but as the owner, that's income that you're giving up.
And you're not getting rent from all the
No.
other floors. You're not getting a higher rent
No.
Right. And
because you took that floor offline, yeah.
And potentially, if you do a really good job, maybe either you're lucky in securing a tenant sooner, or maybe you get a little rental premium, but since office leases are so long to begin with, it could take you 10 years to get a premium from some of the existing tenants. So it's really hard to make the numbers work, but if you're in an environment where you think you might not get any leasing done, it could be the thing that puts you over the edge.
One thing I don't think any of us mentioned, but we're seeing a lot of, not in New York so much, are rooftop, a rooftop facility. And it's
DC.
Yeah, we built one in New
DC,
York.
Chicago, we've
We
seen
have
them
one
right in New
Our
York.
1370
Yes.
Office building. We
But
built a
they're,
rooftop.
very, very important for tenants to have that as an amenity as well. It's got, the full Wi-Fi. It may have an enclosed area or a trellised area, for when it's hot, but having meetings up there, having gatherings up there, but having this, again, the air and the space and feeling this kind of healthy wellness environment seems very important. We're seeing a lot of that.
Yeah,
And I think if
once
you look
get-
up around New York, you'll see a lot of terraces
Yeah.
now.
Yeah, and once you get out of New York, people want that indoor-outdoor space because there's more land available. I find on the West Coast, people look for their amenities are not so much what's necessarily in the building, but is there food that I can walk to and I don't have to get in my car and drive to? So there's different things that people are looking at in different areas.
Years ago, we took a suburban office park that wasn't doing so great on the West Coast and kind of did a huge renovation. But what we did mostly was on the outside, and we redid the entire landscape in front of the building and created a food truck court where you had permanent food trucks come in and service the building every day. And I mean, there's lines around the corner every single day, and people come from other buildings to these buildings, and it's really kind of jump-started those
Is
buildings.
it still full or?
It is leased. The physical occupancy is less than it was, but people do come in. The problem with office is that unless you're going to go to a fully hoteling type structure, if everyone comes in on Tuesday, Wednesday, and Thursday, and everyone comes in on those days, you actually don't get to use that much less space. You're just not using the space on Monday and Friday. If you were able to evenly parse out the people across the week and say, this many people come in on Monday, then maybe you could truly shrink your footprint. But otherwise, it gets a little difficult.
As everyone is talking, I was thinking about how, there's panels that I'm sure all of you guys have already seen talking about some of these topics, but I just thought for just a minute if I could just tie it back to asset management for a second, because you've probably heard people from other companies talking about these types of issues, but maybe they're not in asset management. So I just, for just a second, wanted to just mention the types of stuff that we're talking about, at least at Silverstein, and I would imagine for all of you guys as well. These are the types of things that we were talking about when COVID started and years before COVID, because we were starting to see, as part of asset management, is looking ahead and getting out in front of things before anybody else is even thinking about it. So you can mitigate that issue or that risk before it even happens. So there's no issue, right? So a couple of years ago, it's trying to figure out, well, what's the future of office? And starting talking about all of this stuff, running the numbers to figure out, do you take the one floor offline to create an amenity space, or do you keep renting it? And what does the analysis look like so that you can make informed decisions about that strategic aspect of the business? And I think so many of the things that we're talking about now, just to bring it back to asset management, it's kind of everything that we've been living and breathing, at least from an office perspective, and now again, starting from the multi perspective, on top of what else is going on in the market, what's happening with the capital markets, the leasing environment. It's sort of bringing all of those things together to try to make strategic decisions ahead of time, if possible, so you're proactive, not reactive, to be able to maximize value. And it just occurred to me that we're talking, but you probably have heard some of this stuff from other people within organizations, but I don't know if you guys have anything else to add on that, just the asset management piece of what we're talking about.
As part of your job as the asset manager, if you don't believe in the market, the location, the building itself, then you're going to recommend selling it. And you'll take your losses there. So we've been evaluating, and honestly, I'm selling some stuff that can sell too. You also have to make a decision what could trade in this market. And we're holding on to some office stuff because we can't trade it right now. And I'm selling some of my multi that's actually positioned well because I know we can execute a sale. Not a great sale, but a sale.
I also think you have to look at, kind of what fund is investing in this asset. So we have a bunch of different funds. We have core plus, value add, all open-ended, and then we have a bunch of closed-end funds. If a fund is at the end of life, you might make a different decision on an asset than if you could hold it forever and it's marked to market each quarter. And so, while what might be right for the building in a box, when you kind of layer on the portfolio, there's a lot of other decisions. And does the portfolio need liquidity? Can they afford to hold on to it? What's going to happen when the debt matures?
Or for the investment dollars.
Right, and so
justify it.
if the debt's maturing and they happen to have a lot of money, it might not matter and they can pay off their loan. Maybe there's a partner at play and maybe the partner's having problems or wants to create a liquidity event. And there's all these things to think about on top of just the real estate. And so you have to think about the structuring and kind of the goals of the fund.
Yeah, I was going to add that for many of the deals, especially the larger ones, there are limited partners, there's a general partner, and people have different desires and different timelines. And you may have gone in thinking one thing, and then you could spend most of your time not really focused on the asset, but much more on the management of the different interests that are focused to come to some kind of resolution. And sometimes you can. I mean, we're in one situation now where there's a potential forced sale because nobody can agree. And that's not a position you always want to be in because nobody's really in control. The documents are in control.
Unless the math works that it does make sense to sell.
In a
And
day,
that's-
yeah. It never happens in a good market. It only
Yeah.
happens in a bad
Yeah.
market. So
Another thing about being a good asset manager, someone said to me once that an asset manager is the CEO of their building. You have to know everything about the building, the ownership structure, everything going on at the building. The truth is we have these documents, these joint venture documents, and those are kind of what happens, I'll call it in a worst case scenario. But in reality, you're trying to figure out and negotiate on your own, and nobody really wants to execute the rights and remedies that you have in your documents. You want to figure out the right solution for all the parties together. And so knowing what your rights are is a helpful way to be able to negotiate those.
I think as the asset manager, you have keyed it. You have to be proactive, and you're balancing a whole bunch of interests. You're balancing the tenants on the one side, you're balancing the lenders on the other side, you're balancing the owners, and so you're trying to keep everybody happy, grow the asset, and please everybody around. So I think you guys have the toughest jobs out there, so I commend you for that.
I want to add one thing because we also have to educate, we have third-party managers and they're managing our multifamily for us, and I have to educate them that they are working on a several $100, $200 million asset and instilling their ability to make good decisions, communicate, over-communicate is something too, because we rely on these third-party management teams to execute our strategies, and you've got to make sure you're communicating with them and empowering them to feel good about what they're doing.
Yeah, that communication is huge. The communication and the coordination, we're often the central point, and we have to make sure that everybody else that we're working with, whether it's internal in-house people or third parties, everyone's kind of rowing in the same direction in accordance with the business plan, and it's up to asset management to really make sure that's all happening at the same time that you're trying to figure out and make all these strategic decisions and think ahead. And it's why it was never a dull moment in a lot of what we were talking about as it relates to what we do.
It's crazy. We are running out of time, but before we go to questions, I just wanted to end with a fun question for each of you, because we talked about how do we attract the tenants in the market. So I'm going to ask each of you, what's the craziest amenity that someone has asked for, and did they get it? So my favorite for me was the big ass fan. It's a brand, it's for real, and they go in big industrial warehouses, and I had never heard the word before, and I thought it was fun, so that's my favorite.
Mine is a residential one, and wasn't for ours. It was just the craziest thing I had heard of was a car elevator, so you could drive your car up into your unit, into your living room. I thought that one was interesting.
I guess we're so conservative. We haven't had really any crazy requests, but we did just finish renovating a lobby of a building, and a tenant who's looking at the property said they don't like anything and they want us to completely refurbish the lobby, which we literally finished last year. So I would just call that a crazy ask.
Well, just residential tenants do that also. I've got to fix up a lobby I just renovated because no one likes the accent treatment. So I'm going to fix that up. But I did hear a funny story out of the UK yesterday. We leased an office building to a big institutional tenant, and we apparently won the deal because we had outdoor space, conference space, gym, but we also had a spa. And we were able to secure a global investment tenant.
So we haven't had this as an ask, but we've now heard of office buildings that are kind of contracting with crazy car companies like Ferraris and Corvettes and whatever, and then allowing their tenants to use that as an amenity for themselves.
Interesting. All right.
And that's been in multi.
It's been both.
Never a dull moment. All right, so is there any questions out there? Yes.
For those of you who have multifamily assets or portfolios in New York, how are you thinking about the new Airbnb regulations? Because I don't know the numbers, but just from reading, it said that a lot of supply of market rate apartments had come offline for Airbnb. So do you expect those to come back online, and how do you expect that to impact your bottom lines or rent overall in the city?
We don't allow Airbnb, period. So it's in our leases, we don't allow it. But we do allow corporate tenants. We have some corporate users that rent out for a period of 3 months or 6 months, but they do a lease with us. But we've kicked out Airbnb.
I think most institutional owners have not allowed Airbnb,
Yeah.
so it's been maybe in a slightly lesser quality building that the Airbnbs have been happening. So while there might be an influx of supply as those come back online, I don't think that we're thinking they'll compete that much. Or we're hoping they won't.
Other questions?
Hello, my name is Nicola Coley from CBRE. Currently in your office or multifamily portfolio, what is your favorite building, and what has been a creative strategy to keep it your favorite building?
Oh, that's a tough
It's like asking what your favorite kid is.
All your
I don't think we're supposed to answer that.
I would say, I don't know if it's favorite, but our most fun building for me, and this is very personal, we actually own the Ferry Building in San Francisco, if anybody here is familiar with it. And it's a really fun building because it's such a landmark. It's, it's down at the ferry. It was built in the late 1800s, so it's very old. It's just a remarkable structure. Tons of food on the ground level, the street level, and it all has to be local. There are no chains in there, so they're all San Francisco purveyors. And something I didn't know until we looked at the due diligence and then actually bought it is that on the floor above all the food, there's an entire entire level of office space that is, I think, the highest rental rate office space in San Francisco. It's magnificent when you're in there to look out. And I can't say who the tenants are, but they're very high tech and they're doing really cool stuff that a lot of you have probably played around with. So it's a great property tour as well. But that's me personally. I'm not speaking on behalf of PIMCO Prime.
The one that I've had a lot of fun working on too is 120 Broadway, which we own, which is about 105 years old, downtown in the financial district, and it's incredibly historic, and it sparked the zoning laws in New York, and it's almost like this treasure. It's got a ton of character, and we've done a lot of things to modernize it and create some really great amenity spaces. We've got a rooftop terrace, and the list of amenities goes on and on. But when we were renovating our lobby a couple of years back before COVID, every time the guys would, pull a wall, demolish a wall, demolish this, there was all these cool things we would find. We found an elevator shaft that wasn't used. So there was just all these historic elements to it that we keep uncovering, even going into a tenant space when they move out and we demolish it. It's been a lot of fun.
All right, anything else? Oh, in the back?
Hi everyone, my name is Alice from Cornell University. Thank you for being here today. I was wondering, when we think about asset management, is there a disconnect ever with the acquisitions team, for example, learnings in terms of lease up? Oh, you're laughing already, great. Learnings in terms of lease up or the staffing needs. How do you ensure that these learnings are communicated to the acquisitions team, and how do you work with them?
We work with them closely, very closely. I got here late today because I was on 2 calls with our acquisition team. But at Invesco, which I like, we are hand in hand with the deal guys. And when I underwrite a deal, I have to bless it. I have to live with it also. They don't have to live with it, and that's sometimes the problem.
Right. It's a very astute question, and I think that's true. I think the best way to deal with it is to have some cross-pollination, in the course of your career, because it's easy to buy and think it's the greatest thing, and then you never think about it again. and you're leaving it to the asset managers. So agree with Lesley, and I'm sure for all of us, we have to be an integral part of the underwriting and bless the business plan because we have to execute it. But on the other hand, we have to sort of temper sometimes the acquisitions people because, of course, they want to buy it, and that means being aggressive in a good market.
Yes. And it's truly a partnership. You know, you have to be very open and upfront with the acquisitions people and have a really good relationship with them. At the end of the day, by nature, asset management folks are a little bit more conservative. If we were underwriting the deals, we'd probably never buy anything, and you have to acknowledge that. We also, maybe if we were doing the assumptions, we'd have, you know, different investment rates or some other way of looking at it, but that's not how the market does. So you have to find a way to kind of marry the two and find a happy medium and something that you can live with.
Yeah, when I mentioned in the beginning, I did both. At one point, I worked at a shop that was small enough that we had one team doing both acquisitions and asset management. And it was an incredible learning experience to have to underwrite a deal and then live with it, like you said. It taught me so much, and I think sometimes even if you want to be just doing acquisitions, having spend some time on the asset management side, and it will make you that much more knowledgeable about how to underwrite a property.
One more question. Hi, I'm Ben Haggard. I'm a student at Schack, and this one is for Carly Miller. So last year after we met at Speed Networking, we did a Zoom call, and I asked for advice on feedback and communication in the office. And from my understanding, what I took away was, you know, make it direct, and there's no need for the sandwich method or sugarcoating because most people know what they're doing, and it's more effective going that route. And so it's been super helpful ever since then for the past year. And what would be one other crucial career advice that you would tell us to implement?
Ooh, career advice. Let me think about that one. Well, depending on where you are in your career, I think there's a couple different ways you can go with this. The first thing is, in the beginning of your career, ask questions. In the beginning of your career, you are at a point where the expectation is that you know nothing, and there's this really safe period of time that you can ask a lot of questions. And some people have too much pride or don't feel comfortable asking questions. And a year later, the expectation might be that you now know what you're afraid to ask about. The other thing is, I am the first to admit when I don't know something, even at this point in my career, and I'm not embarrassed to ask about that. And I think that people who feel that they need to know everything and kind of answer questions very definitely and kind of don't say, I'm not sure about that, you can get caught if someone knows more than you do. And I think that it makes you seem just a little bit, I don't know what the word is, but I think it makes it easier to kind of work with you, and it makes people want to help you. Anyone else have other advice?
All right, thank you.